Hey everyone, today we're going to be going over tutorial 5 of the investments tutorial, which is based on chapters 9 and chapters 22. It's a pretty quick tutorial, so let's get on with it. In 2008, you put together a portfolio with a total market value then of 15 million, split 65-35 between equities and bonds. At the beginning of 2013, your portfolio has a total market value of 19.3 million, with the equity component having a total market value of 11.8 million and the bond component having a market value of 7.5 million. Describe how you would rebalance your portfolio to return to the original 65-35 asset allocation. So this is basically the answer. We've got our 15 million Rand portfolio, split 65 to equity, 35 to bonds. And then a few years later, in 2013, this portfolio has now become 19.3 million. So the target split would be this, so 12.5 in equity and 6.7 in bonds. But what it currently is at, it's currently sitting at is 11.8 in equity and 7.5 in bonds. So what we basically have to do is we have to rebalance this portfolio, these amounts here, to reach our target portfolio. So to rebalance, we will sell bonds. So it'll be 7.5 million minus 6.755. So we'll sell 0.745 million worth of bonds. And equities, it looks like we'll have to buy. So we'll say 12.545 minus 11.8 gives us 0.745 million of equity. Okay, multiple choice. So Jill Davis tells her broker that she doesn't want to sell her stock that are below the prices she paid for them. She believes that if she holds onto them a little longer, they'll recover, at which time she'll sell them. What behavioral characteristic does Davis have as the basis for her decision making? So the answer is loss aversion. Most of these questions are pretty straightforward, and most of them are actually theory. So yeah, I'll go over them very quickly. So after Polly Schramm sells the stock, she avoids following it in the media. She is afraid that it may subsequently increase in price. What behavioral characteristic does Schramm have as the basis for her decision making? So fear of regret, representativeness, mental accounting, it's A. Fear of regret. So 3, all of the following actions are consistent with feelings of regret except, so selling losers quickly, hiring a full service broker, holding on to losers for too long. So the answer for 3 is B. 4, which one of the following would be a bullish signal to a technical analyst using moving average rules? A stock price crosses above its 52-week moving average. A stock price crosses below its 52-week moving average. The stock's moving average is increasing. The stock's moving average is decreasing. So the answer is this, A. Number 5, a passive asset allocation strategy involves investing in the stock of companies which are price takers, maintaining approximately the same proportion of a portfolio in each asset class over time, varying the proportion of a portfolio in each asset class in response to changing market conditions, selecting individual securities in different sectors that are believed to be undervalued. So the right answer is B. An investor has a long time horizon and desires to earn the market rate of return. However, the investor will need to withdraw funds each year from their portfolio. The biggest constraint a planner would face with this client is a something constraint: tax constraint, risk tolerance constraint, liquidity constraint, social constraint. So it's liquidity. Life insurance firm wants to minimize its interest rate risk and it's planning on paying out $250,000 in 5 years, which one of the following investment best matches its goals? High yield utility stocks, 5-year zero coupon bonds, 10-year coupon bonds, money market instruments rolled over as needed. So the correct answer is B, 5-year zero coupon bonds. At which one of the following institutions is liquidity usually the most important? There's mutual funds, pension funds, life insurers, banks. So I think, yeah, D is definitely the answer. For an investor concerned with maximizing liquidity, which one of the following investments should be avoided? Real estate, bonds, domestic bonds, international stocks. Real estate. So the answer is A. Go Global Investment Management has an asset allocation of 60% US investments, 40% global investments. Within the US, Go Global has allocated 70% of its portfolio to equities and 30% to bonds. They now hold 3% of its US equity portfolio in the stock of Wally World. Internationally, Go Global has allocated 55% to equities, 45% to bonds. About what percentage of Go Global's total portfolio is invested in Wally World? So Wally World is a US equity. Okay, so we'll say 60% because that's what's invested in the US. And then within the US, they've got 70% to equities. And then of that 70%, 3% is invested in Wally World. So it'll be 60% times 70% times 3%, giving us a total of 1.26%. A portfolio is comprised of 3 index funds, an equity index, a bond index, and an international index. The portfolio manager changes the weights periodically according to forecasts for each sector. This is an example of a passively managed core with an actively managed component, a totally passively managed fund, a passive asset allocation with active security selection, and D, active asset allocation with passive security selection. The right answer is D. If the daily returns on the stock market are normally distributed with a mean of 0.05% and a standard deviation of 1%, the probability that the stock market would have a return of negative 23% or worse on a particular day, as it did on Black Monday, is approximately. So to get the probability, we'll say 1 minus the normal distribution of our Z-score. So this 23% minus 0.05 over 1%, that's basically how you calculate your Z-score. And the answer to this is basically 0. An investment advisor has decided to purchase gold, real estate, stocks, and bonds in equal amounts. The decision reflects which part of the investment process. So the answer is asset allocation. Yeah, so that's it for this tutorial. I'll see you in the next video. Thanks.